Ok. Boa tarde a todos. Eu sou Henrique Heller, presidente da FGV Finance. Antes de mais nada, gostaria de agradecer a presença de todos que estão nos acompanhando hoje. E hoje eu vou ter o prazer de conversar com um dos maiores nomes do mercado financeiro, Howard Marks, sócio-fundador da Oaktree Capital Management e autor dos livros The Most Important Thing e Mastering the Market Cycle. Nós vamos falar um pouco sobre sua trajetória profissional e também discutiremos alguns dos principais temas atuais do mercado financeiro. O evento será em inglês. Obrigado a todos pela presença. Good afternoon from Brazil, Howard Marks. To begin with, I'd like to thank you for your presence here today. You are one of the biggest references in the financial markets, as well as one of the greatest inspirations for young students pursuing a career in the industry. It's a great opportunity for the whole Brazilian finance community, a huge pleasure for our finance club, FGV Finance, and of course, for me. I'm delighted to talk to you today and hear a bit more about your history and thoughts. To start off with, I'd like to ask you if you could tell us about your career path as a student and as a professional, and how did you get where you're at today, Mr. Marks?
Well, I think it's a simple story. You know, you'll meet people who say, I knew what I wanted to do all my life, but that wasn't my case. I changed career ideas many times in high school. And in my high school, they actually had a course in advanced accounting. So I took that and I really liked that. So I said, I'm going to become an accountant. And my dad was an accountant. So I was fortunate to gain entry to Wharton. And I went off to Wharton expecting to become an accountant. But I met finance there and I found finance more interesting. So I changed my major to finance. I finished at Wharton. Then in those days, it was common to go straight from college to graduate school. So I applied to graduate school and, you know, I didn't get into Harvard or Stanford, but I went to the University of Chicago, which was very fortunate because they were teaching a theory of investing, which has now become very important in the investment world. And because I went there, I was one of the first to learn it. And you know, when you're at the front of the line, it's a great advantage. So I finished my degree there. I took a degree in accounting. I finished that degree and I came out and I went to Citibank, first, what was then called First National City Bank, to start my career. And this was 1969, summer. And so I joined the investment research department there. And I spent time as a security analyst studying conglomerates and business services companies, business products. Then the oil embargo occurred in 1973, and the bank, which was a growth stock investor, turned around and found that it didn't have an oil analyst. So they asked me to start an energy group, which I did in 73, and then to start coverage of what we call the basic industries: steel, metals, paper, forest products, and so forth, which I did, chemicals. And then in 1975, I became director of research. 1978, it was time to move into money management, and I was asked to start a convertible bond fund. And convertibles were the English term is backwater. That is an ignored area of investing. But I did it, and I found it extremely interesting and very quantitative, and I enjoyed it. And then a few months later, I got a call that changed my life. The head of the bond department asked me if I could figure out what high yield bonds are, because a client had asked for a high yield bond portfolio. So I started that in late 78, which was the beginning of the high yield bond world. Again, Enrique, front of the line, very lucky. So I was managing convertibles and high yield at Citibank from 78. And in 1980, I moved to California only for quality of life. I thought it would be a negative career step, but good for my life, so I did it. And it turned out it was a very good move overall. 85, I switched to a Los Angeles company called Trust Company of the West, TCW. and I spent 10 years there. I met my Oaktree colleagues there, and in particular, Bruce Karsh, who was my partner and my co-chairman at Oaktree, and he had the idea of starting a distressed debt fund. So he convinced me that that was a good idea, and we did that in '88. He joined me in '87, and we started that in '88. First distressed debt fund from a mainstream financial institution. Guess what? Front of the line. And that's really a recurring theme. And so we did that, and that was a great success. And then we broadened out into other strategies: distress for control, distressed mortgages, international convertibles, bank busted convertibles. And by '85, we were managing $7 billion, which we thought was a lot of money in 7 strategies. And 5 of us left as a group to start Oaktree. And again, very fortunate, because in the last 10 to 15 years, because the central banks have brought the interest rates so low, most institutional investors have concluded that they can't get the returns they need from stocks and bonds. So they need what we call alternatives. Now, that word didn't exist 20 years ago, but now we call it alternatives. And it means private equity, venture capital, hedge funds, real estate, distressed debt, things of that nature. And it happens that we were well positioned to do that, along with Blackstone, Apollo, Ares, Carlyle, et cetera. And, again, that's the place to be. So as I said, we had $7 billion when we left TCW. We were fortunate to bring 6 of the $7 billion over to Oaktree when we started. So we never had to struggle in the beginning. And now we are over 150 billion. That's the whole story.
It's incredible to hear your story, and hearing that brings tangibility to the dreams of us young students of one day being a great reference in the financial markets as well. Good. And as a young student pursuing the financial markets dream, it's necessary reading books, and one great reference is Mastering the Market Cycle. In this subject, what would you say is the market cycle that we are currently in? And given the low interest rates, what are the investment opportunities?
First of all, you have to realize that I've been through now 52 years of investing, and I've lived through, 5, 6, 8, 10 cycles. And, I've studied the cycles. I believe cycles are very important and so forth. But the things that happened last year were not cyclical events. You have to realize that. The coronavirus was an exogenous event. That means it came from outside and, as a shock, and, the most serious health event in the last 100 years. And then in order to prevent the spread of the disease or limit the spread, most countries shut down their economies. You can't have people going into stores, movie theaters, restaurants, concerts, et cetera, and hotels. And, they would just pass the disease on. So they closed all that. But of course, that brought on a very serious recession, the worst recession in history in terms of the second quarter of last year, down a third on an annualized basis in the US. And that wasn't cyclical either. That was a man-made recession and a man-made closure. So the key is, of course, that the Fed and the Treasury took very strong action to rescue the economy, and it was very successful. And so the market came right back. Just to give you some perspective, the S&P 500 was around 3,300 on February 19th. 35 days later, on March 24th, it was 2,200. So it went down by a third in just over a month. But then the Fed and Treasury took their action. March 23rd was the low. Market went pretty much almost straight up from there. It closed the year up 18% for the year, which means it was up about 60% from the low. And today it's up 100% from the low. Now, your question is, where do we stand cyclically? This is a great question. Normally, good economic news makes the market go up. Bad economic news makes the market go down. So normally, the market and the economy move similarly, not exactly the same. There are leads and lags, and one goes first and the other goes second. And the leads and lags vary from cycle to cycle. But for the most part, the market rises as long as the economic news is good. Sometimes it declines in anticipation of a slowdown. But then when the economic news turns bad, then the market turns bad and that goes down. So the two cycles are related and largely in parallel. This time, that's not the case. This time, the market has been very strong now for a year and a half, since March, on September 23rd, it'll be a year and a half from the low. Market's been extremely strong, as I described. All asset prices are high. There are very few bargains around. There's nobody, there's no forced sellers. There's no panic. So it's hard to get a bargain. On the other hand, the economy it's in recovery, but it's early in its cycle. The last year, the third quarter was the best quarter in history, also up a third on an annualized basis. And then the growth has been good in the first and second quarters of this year, up 6-7%. But it's young. So we have a young economic recovery, which we imagine will go on for some more years. But we already have a market which is very high. That's unusual. So now the key is, okay, those are the facts. The key is, what is the significance of that? You could say, Enrique, I'm worried because the economy isn't completely strong and stock prices are already very high. So, I worry. But you could also say, yes, stock prices are high, but the good news is that the economic recovery is young and probably has years to go. So I don't worry about a recession or the market topping out anytime soon. And my own feeling, the market is quite high. There are things that are troublesome, worrisome in the market. But I think that as long as the economic news is good, the market is not going to correct. The last thing I'll say about the market, and it's not related to cycles, is that asset prices are very strongly affected by interest rates, because the Fed sets what's called the Fed funds rate, which is kind of like the riskless rate, the base rate for all markets. And then the demanded returns on securities scale from that. Because everybody says, well, if I can get X on the market, on the risk-free rate, if I'm going to take some time risk, I need 100 basis points. If I'm going to take corporate risk, I'm going to need 300 basis points. If I'm going to go to high yield bonds, I need 500 basis points, and so forth. And equities, I need 700 basis points, whatever it might be. So the riskless rate sets the floor, and everything scales up from there. But of course, the riskless rate is so low that the demanded returns and the a priori returns, I don't know if you know that term. A priori means what we're looking at in the future. They're all very, very low. We have the lowest interest rates in history. So it wouldn't be unfair if we had the highest prices in history and the lowest prospective returns in history. I wrote in my last memo that a bubble is an irrational state. And today's prices are not irrational. They're rational based on interest rates. Things are priced fairly relative to interest rates and relative to each other, but they're priced high. And obviously, if they're priced high because interest rates are low, then if interest rates rise, that's a source of exposure. And you can lose money because if interest rates rise, prices will go down, probably. So this is something to think about. And again, you have to figure out whether you think interest rates are going to stay low or not. My own guess is interest rates will stay low-ish. You know, ish means sort of. Not as low as they are today. They'll, 2 years from now, they'll be higher, but I don't think they'll be terribly higher. And so I find it hard to bet against the stock market. Now, I'm not that attracted to it because prices are so high. I don't think it's time for an aggressive behavior, but at the same time, I don't think it's going to collapse. I think it's hard to bet against the stock market at this point.
Mr. Marks, on this point, as you said, there are different approaches to face different crises. In your point of view, how should the aggressiveness and defensiveness balance be adjusted in response to our current market cycle?
Well, what Enrique is referring to is, I wrote in my recent memo, you must have read it, that when I go on TV, they try to get me to say buy or sell, in or out. And it's not that simple. So what I tell them is that every investor should have a normal risk posture. Whatever is right for you and your family and your dependents or your business or whoever it is, every investor should have a normal posture, a normal balance between risk and aggressiveness and defensiveness. And then you might be willing to vary your risk posture away from the norm based on current conditions. Some people say, no, you can't predict the market, so I'm just going to stay. Some people are willing to try to enhance their return by timing the market. So the question is, if you're in the latter category, and if you're willing to try some market timing, what should you do today? Should you have more aggressiveness and less defensiveness than usual, or more defensiveness and less aggressiveness? How do you, think of it? I always say, think of it as like the speedometer of a car, which goes from 0 to, let's say, 100. 0 is only defense. 100 is only offense. You might say, Enrique, because you're a young man, you have a great future ahead of you, you're going to earn a lot of money, that you can be 80 on the scale from 0 to 100. So the question is, and that's a pretty aggressive posture. But the question is, will you vary it today? And what should you do? Well, since I find it very hard to figure out this market, and since there are very strong points on the positive column and strong points on the negative column, I come out around normal. In other words, the case, the argument is not so strong for either highly defensive or highly aggressive. If you press me, I would say I would be a little more defensive than usual because of the threat of inflation and higher interest rates, and because asset prices are already so high. But a modest adjustment in the direction of more defense and less offense.
In line with this discussion point, there's a well-debated subject in the financial markets, which is growth investing and value investing. Could you explain the main differences between these two approaches? And is there a best option for the current investment environment?
If you go back 100 years, investing was not studied like it is now. You had a few, lots of people invested. you had a few famous investors like you do now, but it wasn't a big deal like it is now until the Roaring '20s came along. And of course, the market boomed in the Roaring '20s, setting the stage for the Great Crash and the Depression. But you know, there was not much of an investment industry or in professional terminology. Then, you know, you had people come along like Benjamin Graham, who co-wrote the book Security Analysis, which is the Bible of our profession. That was first issued in 1934. Graham and Dodd, his partner, Ben Graham and his partner David Dodd wrote this book. And I think it was the first serious manual for how to invest. And Ben Graham went around picking up bargains. And as I wrote in my memo in January called Something of Value, it was relatively easy to do because there weren't many people pursuing this field. There was not much information available. There were no information technologies like the internet. It was very hard to get information. And most people didn't understand really the technology of making money in the market. They just thought of it as betting like at a horse race. So Graham made a lot of money, and he happened to be the teacher at Columbia University of some young guy called Warren Buffett. And so Buffett, well, let's see, Buffett is 20 years older than me. So Buffett must have attended Columbia in the 40s. And he met with Ben Graham, and he went to work with Graham. And then he went out on his own, of course. And so what Graham and Buffett did was called cigar butt investing. You know, you walk down the street, you look in the street to see if there's left in it. So it's a poor quality asset, but you get it very, very cheap. Cigar butts. And that they became enormously successful at that. Again, the origin was the lack of information. It was not an intelligent market. It was a dumb market. Most of the participants did not have information or the ability to make use of it. Then in the 60s, we started to have something after World War II. We started to have something called growth investing, and growth investing. You know, some companies emerged from the post-war period very successfully. IBM, Xerox, Kodak, Polaroid, Merck, Lilly, Texas Instruments, Hewlett-Packard, Perkin-Elmer, Avon, on and on and on. And so the Wall Street popularized this thing called growth investing. And these were the companies that grew faster than average. And it became very popular, and they did extremely well. And of course, they did too well, and they created a bubble. And the bubble was in something called the Nifty 50, which were the 50 best and fastest growing companies in America. And if you would have bought the Nifty 50 the day I went to work in the summer of '69 and held the stocks for 5 years, you would have lost almost all your money in the best companies in America. But that's another story. We'll leave that out for now. But the point is that growth investing came into existence, and people talked about it as a thing. This is growth investing. Well, then what's the rest? They call that value investing. So now you had what we call a dichotomy. I don't know if you have that word in Portuguese, a dichotomy between growth on one hand and value on the other. And that started like in the 70s or 80s, that dichotomy. And over time, you know, this industry of ours has become highly professionalized and highly structured. So, you know, if you go into a pension fund in America and you say, I'd like to invest for you. Would you give me some money? They'll say, well, do you do large companies or small? Do you do US or foreign? Do you do developed economies or developing economies? Do you do growth or value? You see, highly structured. Every investor falls into some pigeonhole so that he can identify and describe what he does to make it consumable by the clients. That, and as I say, this probably started around the 70s or maybe the 80s. And as it has progressed, it has become more and more rigid, so that value has come to be defined as, well, these are not companies that are above average in growth. Matter of fact, many of them are stagnant or below average in growth. They're not technological. They're stable. The advantage they have is that they're predictable because they don't change much. But the main characteristic of value investing is that these things are cheap, so that they sell at very low valuation parameters, things like PE ratio, ratio of price to earnings, ratio of price to sales, ratio of price to book value. Book value is the asset value. S&P takes the 500, which is the main index, the S&P index 500, and divides it in half, which are the 250 companies that are the fastest growing, and which are the 250 companies which are the cheapest. And that's the dichotomy. But, if you read Buffett, and a lot of the people who are investing in technology, who are in value stocks, think they're emulating Warren Buffett. They say we don't bet a lot on the future. We invest based on the present. We don't have dreams about the future. We don't do technology. We do bargains. And the truth is that Buffett Buffett doesn't do technology only because he thinks it's too complicated for him. But he generally has not invested in growth stocks, but one of his greatest and longest term holdings is Coca-Cola, which was one of the premier growth companies 50 years ago and still is today. And he's made a ton of money in Coca-Cola and he still holds it. And he made the most money in a company called Geico, which is an insurance company, which grew rapidly. So the point is that while he doesn't do technology for the most part, although several years ago he did put a lot of money into Apple and made a ton of money in Apple. So see, the point is that Buffett is more flexible. Buffett is not so religious about it, if you will. But the followers have been too religious, too rigid. We don't do tech. We don't do anything that has a full price. We don't do this. We don't do that. Buffett says there's no such thing as growth investing or value investing. There's just investing. That's what we do. So the point is, I wrote a memo in January called Something of Value, and and it was the result of spending much of the pandemic with my son and his family. My son is an investor, but he's much more young than me, and he's more flexible, and he grew up with this stuff. So he worked me over. And the truth is, I believe that investors should be more flexible. And just because something is cheap doesn't mean it's good. Just because something's expensive doesn't mean it's bad. The value investor, I don't want to insult anybody, but the value investor goes out and buys Volkswagens and Toyotas and things like that. But the growth investor, he might invest in a Mercedes-Benz, which is more expensive than all the other cars, but he thinks it's so good that it's worth it. So that's really the difference. The analogy to the cars is a little forced, but the point is, just because a company is a great company and sells at a high PE ratio doesn't mean it's a bad investment. Just because it's slow growing and predictable doesn't mean, and low priced doesn't mean that something's a good investment. So you should look at the various styles of investing. You should understand them. You should try to figure out which ones appeal to you. But the point is, you shouldn't be rigid, and you should do a deep study. Now technology, it's hard today in 2021 to say we don't do technology. Technology is everywhere throughout the whole world. That wasn't the case 60 years ago. And even low-tech things like newspapers can be profoundly affected by technology. Or how about stock brokerage firms can be highly affected by technology. And a lot of investment products are now distributed via the internet. So you can't invest in this world and say, I ignore technology, because, most industries have the potential to be disrupted by technology. So I would just leave it at that, but I would say that the point is, you shouldn't make superficial judgments. You look at a stock and it's a tech stock and it's selling at 50 times earnings. The whole market sells at 20 times earnings. So you could say, well, it's terribly expensive, we don't buy it. But until you know enough about it, you don't know that it's not an attractive investment despite the price.
Howard Marks, on the technology point, I would say that it's very interesting that in our current investment environment, was the tech companies boom, a subject that has different points of view on. And in your memo 2020 review, you quoted the opening lines of Charles Dickens, A Tale of Two Cities, quotes, "It was the best of times, it was the worst of times. It was the season of light, it was the season of darkness. It was the spring of hope, it was the winter of despair." In your point of view, Mr. Marks, do you see the tech companies boom as a spring of hope or as a winter of despair? And what would you say are the most promising technologies for the next years?
Well, look, I think that technology is only going to become more important in the coming decades. I think that the number of industries and companies that are affected by technology will only grow. Human knowledge never goes backwards. We never know less than we did the day before. And I think the same is true of technology. And I think that more and more things are being affected by technology. So technology holds some of our best hopes for the future. How about feeding the planet? I think technology will help us increase our production of food and water, and hopefully it'll help us do something about climate and so forth. So I think the importance of technology is only going to grow. Now, when you talk about the best and the worst, despite that, of course, technology has downsides also. Technology puts people out of work through automation. And, one of the great questions for the next 50 years is, where are we going to find jobs for everybody? Because, jobs that used to be done by humans are now done by machines. And I once heard that the factory of the future consists of one man and one dog. And the dog's job is to keep the man from touching the machinery, and the man's job is to feed the dog. But I do think that automation is going to be an issue for society in the coming years. And the great benefits of technology, which is the labor saving, also has a downside. But I think technology is a wonderful thing. And I think that people who understand technology and technology investing, I think will have lots of opportunity. Now, that doesn't mean that investing in technology is easy, because if you're somebody who's tech savvy, you're going to be competing against other people who are tech savvy. And if they're more, do you understand what I mean when I say savvy? Okay. So the people who understand the best will make the most money, and the people who understand the worst will lose money. It's not like they open a window to technology and everybody who goes through the window makes a lot of money. You move on to a very competitive environment. But if you have a strong understanding, I think that you can make a lot of money. And of course, now venture capital is doing extremely well, and people are flocking to venture capital now, both to do startups and also to work for VC funds, which invest in early stage companies. So that's a great opportunity. Now, one thing that everybody has to understand in the audience is that everything, even a good thing, can be overdone. It can be overcrowded and it can be overpriced. And when a good thing becomes overcrowded and overpriced, then it becomes a bad thing. One of my favorite sayings, or perhaps my favorite saying about the investment business, is that what the wise man does in the beginning, the fool does in the end. So I talked a lot, when you asked me about my history, I talked about the benefit of being first in line. It's great to be early. And the people who get to invest in a good thing early usually make a lot of money. But if you invest in the same thing later, when everybody knows about it and everybody thinks it's a great thing and everybody's happy to invest in it and everybody else has driven up the price, then maybe it's a bad thing. And that's what you have to watch out for with technology.
And Mr. Marks, this answer motivates me to ask you a question about risk. Would you say that the statement, the higher the risk, the higher the return, is correct?
You know, Enrique, I'm glad you asked that question. I don't know how you got the idea to ask that question, but that is one of the most dangerous statements in history. And many people believe it. And in my book, The Most Important Thing, there are 3 chapters on risk. There are 21 chapters. Each chapter says the most important thing is, and then it's a different thing. Because in investing, there's not just one important thing. There are many important things. But risk gets 3 chapters because I think that risk is extremely important. The first one says the most important thing is recognizing risk. Second, understanding risk. Third, managing risk. Very important. Now, if you look in the book, I wish I had one here. Oh, well, let me get one. I'll be right back. Okay. My book just came out in French. So I'm looking, by the way, of the foreign languages, the first language was Portuguese, you know. But, wrong book. This is market cycle. But we have what's called the capital market line. And it looks like this. So here we have, down here, we have on this axis, we have return. And on this axis, we have risk. And we have a line that goes like this. So it goes at an angle, upward sloping to the right. And we say that there's a positive relationship between risk and return. Down here, we have the risk-free rate at the bottom. And then as we move to the right, that is, as the risk increases, we move up the vertical axis, which is to suggest that the return increases. Why? Because if you look at 2 investments, one of which is riskier than the other, you will insist that the riskier one appears to have a higher return, or else why would you make it? Why would you make a riskier investment rather than a safer investment if you didn't think it would offer a higher return? So that's the way the markets work. And as the expected risk increases, generally speaking, the expected return increases. So stocks are expected to return more than bonds, and US stocks, risky country stocks, emerging market stocks are expected to return more than developed world stocks, and small company stocks are expected to return more than large company stocks, and so forth. Now, your question. Many people look at this line, this upward sloping line, and they draw two conclusions. Number one, the more risk you take, the more money you make. Number two, if you want to make more money, the way to do so is to take more risk. Sounds very easy. One thing about investing, it's never easy. So the truth is that's too easy. If it were, think about it. If it were true that riskier assets have higher returns, everybody would invest in the riskier assets, and would drive up the prices so you couldn't get the bargain. But even more important, if you think about it, if you say riskier assets have higher returns, if it were true, then by definition, they wouldn't be risky. So it can't be true that risky assets have higher returns. But when people think about the capital market line, they often reach that conclusion and they get into trouble by reaching for more risk in order to make more return. So what is the truth? The truth is that riskier assets, as I said, have to appear to offer more return, or else nobody will be attracted to them. But they don't have to deliver. And that's the key. And that's what I want everybody in your audience to understand, that the idea that you can make more money simply by taking more risk is an illusion. And it gets people into trouble all the time. Because when things are going well, riskier assets do better than safe assets. Because in a positive economic environment, if you take a risk, chances are you'll be rewarded. So in good times, everybody says, well, you know what, I made a very risky investment and it worked out fabulously. So now I'm going to double up. Now I'm going to do twice as much. But that's in the good times. When the bad times roll around, the risky assets do not perform well. And the more risk you take, the more money you lose. But they forget about that. You know, I like to play blackjack, and in casinos, and I play for very low stakes. I play for $10 a hand. I'm a chicken. But the pit boss, the guy who manages the casino, comes around, and what does he say, Enrique? He says, the more you bet, the more you win when you win. Well, you can't differ with that. It's obvious. The more you bet, the more you win when you win. What he doesn't say is the more you bet, the more you lose when you lose. And in the good times, people forget about that. But in the bad times, it turns around to bite them. So it's very important to understand risk. As I said, it is the most important thing. And let me just diverge for 1 second. It's easy to make money. I'm sure everybody, all your listeners, will be very glad to hear that. It's easy to make money, especially when the market goes up, and the market goes up most of the time. If you invested in the S&P 500 over the last 90 years, you've made about over almost 10% a year. And what that means that your money has doubled roughly every 10 or 11 years. So if you started and you put money in the market, and I'm sorry, not 10 or 11, 7 or 8 years. So if you put money in the market 40 years ago, let's say it doubles every 7 years. So after 7 years, it's 2. After I mean, after 1 year, it's 2. After 2 years, it's 4. After 3 years, it's 8. After 4 years, it's 16. After 5 years, it's 32. 6 years, 64. 7 years, 126. So you can turn $1 into $126 in 40 years by compounding at the average rate of return. It's easy to make money. But I believe that the mark of the professional investor is that he or she knows how to make money in the good years and not give it back in the bad years. And what does that mean? That means that he or she knows how to find profitable investments with the risk under control. That's what we try to do at Oaktree. And we have an investment philosophy which has 6 components. The first one says that we want to invest with the risk under control, so that we want to do well in the good times, but not terribly in the bad times. And I think that's what we've done, and I'm very proud of the record. But I think that it takes some superiority to do that. And obviously, in order to do that, you have to have an above average understanding of risk, which I would recommend to everybody to study.
It's great to listen to your ideas about the financial markets environment. And talking about risk reminds me of the Oaktree successful case with the Toomey company in 2002. And in your famous memo, Dare to be Great, you mentioned that you like to say Oaktree buys when people say no way and sells when they say no sweat. The Toomey case is a perfect example of that. And can you tell us a little bit more about this specific case?
Well, it's a simple matter. I don't know if everybody knows, but Toomey makes luggage. And it was, at the time, 20 years ago, it was the coolest luggage. Luggage was very old-fashioned, heavy leather cases that people would struggle onto trains with. And Toomey invented making the luggage out of nylon with a frame and a handle and wheels. And so Toomey became very successful. And all these black bags that all the millennials carry at the airport are Toomey. But when we went into a very difficult recession, everybody said, well, we're never going to travel again, because everybody's lost so much money that travel is dead. So if travel is dead, then nobody needs any suitcases. So Toomey stock collapsed, and we bought the company. And because why? Because everybody said, no way, it's over. There's no travel, there's no suitcases, nothing will happen good. So we bought it when they said no way. And then 6-7 years later, we made some changes in the product line and the management, but mostly the market came back. We supported the company through the bad times. The market came back. Company went back to doing extremely well, and we sold the company at a big profit because everybody said, no sweat. There's lots of opportunity for travel and suitcases and profit. So we're not worried about travel anymore. Well, that's a good time to sell it. And that's what we do. And, as professional money managers, we generally don't buy anything and hold it forever. We have a holding period. And so even a good company like Toomey, we have to give it up at some point. And the point is, we were able to buy it at a time when there was only pessimism and sell it at a time when there was only optimism. And if you could do nothing else in life, that would be a pretty good rule. If you're smart enough to pull it off, if you're smart enough to buy when nobody is optimistic, and then disciplined enough to sell when everybody is optimistic. When roughly 50 years ago, I learned what somebody described to me as the 3 stages of the bull market. The first stage, when only a few unusually insightful people realize that there could be improvement. The second stage, when most people accept that improvement is actually taking place. And the third stage, when everybody thinks things can only get better forever. So if you buy in the first stage, when almost nobody's optimistic, you can pay a low price because there's very little expectation, positive expectation built into the price of the asset. And then in the third stage, when everybody's optimistic, all the expectations are positive, nobody's worried about any negatives, the price is sky high. That's clearly, it's not going to stay that way forever. That's a good time to hit the exit. So this is an example, to me, was a very good example of a case like that.
Howard Marks, after this lesson that you gave us today, I'd like to ask you one final question. What is your advice for young students pursuing a career in the financial markets?
Well, you know, Henrique, I'm very glad to answer that question. Obviously, I've had a great career. Investing is a very rewarding job, especially for people who are successful at it. It must not be much fun for the people who are unsuccessful, but if you're successful, it's a lot of fun and it's very rewarding, and obviously it's been possible to make a lot of money. Having said that, I want to say that if you went back 20 years, well, let's say from 1970 or 80 until 2005, that 25-year period, I think that professional investors like me made more money than any other profession in that period. This is the kind of thing that usually doesn't remain true forever because cycles happen, you know. We have one job that's very lucrative, and then 1 million people go into that business. And now there are too many people chasing too few jobs. And so the pay goes down. And then you have too much money flows into the market. And then such that the performance isn't so good anymore. So the returns go down and the compensation goes down. And then you have, you know, new people go into the business. They want to compete with me. They don't have a record, so they can't compete on the record. So they compete by offering to do it for lower fees. So that affects the profitability of my business. That's the way things work. That's cycles. That's cycles in action. So my point is that it has been the highest paying from that period, 80 to 05, roughly. It was the highest paying business in the job in the world. Nobody should go into this job because they expect it to remain so. So one of the things I would recommend to young people is don't do anything just for the money. It's not worth it. You only get one life. And it would be a huge mistake to spend your life doing something you don't enjoy just because you think you'll get rich, because you may not get rich. And even if you do get rich, it may not be enough for you because of the other things you gave up that you wished you had been doing. So my career advice for young people is, well, there's an English writer named Christopher Morley who made my favorite quote on this subject. He said, "There's only one success: to live your life your own way." And I think that's very important. What does it mean? It means don't do anything just because it's popular, just because your friends are doing it, or your peers, or your parents tell you to do it, or the man on TV. Don't do anything just to make money, unless money is the most important thing to you and it's going to make you very happy. But if it's not everything, I wouldn't give up my life just to make money as an investor. My advice to you is do something that you will enjoy, something that plays to your strengths and avoids your weaknesses. That's my formula. Now, you may have to you may have to try different things to figure out what you enjoy and which things play to your strengths and which avoid your weaknesses. But so, you know, you may, sitting here at age 25 or whatever you are today, you may not have the answer already. But I think that that's my recommendation. We spend more time working than any other activity awake. More time working. And you only get one life. So you should spend that time doing something you enjoy. And to do something you hate, just so you can die with more money, doesn't make any sense at all. The other thing that I would recommend is this. Investing is not a science. There is no process that you can engage which will be successful every time. And the things that worked yesterday, the market changes. I tried to describe how cyclical and other developments change the market. The thing that worked yesterday may not work tomorrow because the market has changed. Buying tech worked in 2020, but now tech is so expensive, it may not work in 21, et cetera. So it is, in investing, we have the changing environment, and we have luck, and we have competitive strategies. If you, and as a result, nobody is right all the time. I'm certainly not right all the time. And you know, if you're a great investor, you might be right 2/3 of the time, 60%, 70%, 50%, 55 or 65. Nobody's right 100% of the time. If you want to be right 100% of the time, if you think you'll be frustrated being wrong 1/3 of the time, don't go into investing, because you will be wrong at least 1/3 of the time, probably close to half at best. If you want to be right all the time, there's a book called Fooled by Randomness by Nassim Nicholas Taleb. And in it, he in a sort of humorous way, he compares investing and dentistry. He says, if you go to dental school and you learn to fill a tooth and you fill it every time the same way, you'll be successful every time. Because the mouth never changes. There's no cyclicality. There's no randomness. It's a process that will work every time. If you're a civil engineer and the boss says, I want to build a road from Rio to Sao Paulo, he'll tell you how much steel to put in and how much concrete and so forth. And if you do it, it'll be right. It'll work every time. Every time. There's no randomness. So if you want to be right every time, go into dentistry or engineering. But if you're going to go into investing, you have to be able to live with imperfection. It's very, but that's also what makes it exciting, because you see the dentist, he learns in dental school, 50 years later, he's still filling a cavity the same way, and it works every day. He doesn't have to get up in the morning and say, today I'm facing a unique challenge. What shall I do to make my life interesting and to solve a problem? Like we do in investing. So if you like being creative and imaginative and dealing with changing conditions, then I think investing is a great field.
Mr. Marks, we're at the end of our interview. And once again, I'd like to thank you for your presence here today. I'm sure that everybody who watched this will be inspired to have heard your wise words. I hope you can talk again soon. And thank you, Mr. Marks.
Very good. Well, I wish good luck to everybody who's listening in today. I hope you enjoyed it. And I hope to speak to you again. Thank you for your good questions, Enrique.
Thank you, Howard Marks.
Bye-bye.